Hi students, welcome to the video on ratio analysis. In this video, we will emphasize on activity or efficiency or performance or turnover ratio. In this ratio, our main purpose is to find out the funds which are invested in various assets of the business in order to make sales and earn profits. So the efficiency with which assets are managed directly affect the volume of sales. Activity ratio measures the efficiency or effectiveness with which a firm manages its resources or assets. First we will know what is inventory or stock turnover ratio. Under inventory or stock turnover ratio, we measure the velocity of conversion of stock into sales. Means a high turnover indicates efficient management of inventory. So formula is net sales or net revenue from the operation or cost of goods sold divided by average inventory at cost. Suppose total sales is given and cash sales is given, we will calculate the net sales, that is sales minus sales return, or it is known as net revenue from the operation divided by average inventory at cost. That means opening stock of inventory plus closing stock of inventory divided by 2 will get average inventory at cost. It gives us the number of times a company turn over its inventory related to its cost of goods sold in a given time. It is very useful to a business in guiding its decisions regarding pricing, manufacturing, marketing and purchasing. Then debtor or receivable turnover ratio. Under this ratio, we calculate credit revenue from operations. That means net credit annual sales divided by average trade receivables. It measures the efficiency at which firm is managing its receivable. So receivable includes both sundry debtor and bills receivable. A high ratio indicates that the company's collection of accounts receivable is frequent and efficient, and the company enjoys a high quality customer base that is able to pay their debt quickly. That means the lower is the number of days availed by the creditor or customer of the firm or company, the company will be very sound position. Then creditors or payable turnover ratio. It represents the average number of days taken by the firm to pay its creditors. Lower the ratio, the better it is liquidity period of the firm. If the ratio is higher, then the liquidity period of the firm is post. That means in this case, the creditor will enjoy repayment within the short period. That means when we purchase goods on credit basis from the supplier, supplier will give us less time. If it is high, the turnover ratio is high. Then it is payables or creditor velocity. The formula is average accounts or trade payables divided by average daily credit purchases. Average accounts or trade payable includes both sundry creditors and bills payable. Then average daily credit purchase means we will calculate the credit purchase divided with the number of days in the year, that is 365 days. It will give us average daily credit purchase. It indicates number of times sundry creditors have been paid during a year. So One is receivable or debtor velocity, that is average accounts receivable divided by average daily credit sales. In this case, if the ratio is high, then it provides that the firm is in a sound position. That means the firm is giving less period of credit to its customer. Under payables or creditor velocity, if the ratio is low, it means the company is enjoying more period towards repayment of credit purchase. We can discuss it through the help of this example. Here it is given total revenue from operations 20 lakhs, cash revenue from operation 4 lakhs, then sales return 1,40,000. So out of total revenue, total sales 20 lakh, we will deduct cash sales, that is 4 lakh. So credit sale is 2 lakh minus 20 lakh minus 4 lakh, it is 16 lakh. From 16 lakh, we will deduct the return 1,40,000. So it gives us 40,60,000. Then total debtors and bills received 1,50,000. So 1,50,000. 1,10,000 plus 40,000, 1,50,000. Then in this case, yearly is 14,60,000 divided by 365. It will give us 4,000. Average daily credit sale is 4,000. Then average accounts receivable is 1,50,000. So 1,50,000 divided by 4,000 is equal to 37.5 days. That is 38 days. So we are allowing 38 days to our customer for repayment of our credit sale. Then in payables or creditor velocity, it is given total purchase 8 lakh, cash purchase 1 lakh, so 8 lakh minus 1 lakh 7 lakh, less purchase return 50,000, so it is 6 lakh 50,000. So 6 lakh 50,000 divided by 365, so it is, then average accounts or trade payable is here sundry creditor 1,20,000, bills payable 2 lakh. So 2 lakh divided by 6,50,000 by 365 means into 365 by 3 lakh. 6,50,000. So it is 4 zeros. Then 5 means 4. 5 means 13. 40 424 2 2 4 14 60 by 13. So it is 1 16 13 30 so 113 days. So here we are allowing to our debtor only 38 days, but we are getting credit from our supplier 113 days. So firm is in a sound position. Thank you for watching this video. In the next video we will discuss some other activity ratios.